Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today's video, we're going to talk about pretty much the OG covered call ETF in the US market, QYLD. That's one of the first, if not the first one that came out in 2013, at the end of 2013. And in today's video, I'm gonna talk to you about why I think that the strategy is completely out of dated, why the strategy is obsolete, and the point is really, if you're watching this and you still own QYLD or XYLD, in my personal opinion, I think you should strongly consider swapping out of it for another similar income-oriented covered call fund. And of course, this is just my personal opinion, everyone. This is not financial advice. I'm not a financial advisor, but I think the evidence speaks for themselves. So just a super quick summary. What is QYLD? And of course, there's XYLD as well. A QYLD focuses on the NASDAQ 100 index. XYLD focuses on the S&P 500 index. There's also RYLD, which focuses on the Russell 2000, but they all do the exact same rinse and repeat, same strategy, same exact thing, just on a different index. So QYLD is the most popular. We'll focus on that one, I guess. Basically, you're owning the NASDAQ 100, and what they're doing is they are writing a covered call or a buy right on the entire portfolio. So they're doing one giant at the money call option on the NASDAQ 100. So if you look at the holdings, it's going to have basically the holdings of the NASDAQ 100. If you look at what's inside QYLD, you're actually you are investing in a NASDAQ 100. But like you could see here, and here's the call with the strike price, they're basically writing an at the money call on the entire portfolio. So they're taking in a lot of premium, but essentially, here's the key part to understand, everyone, and this goes for XYLD as well. They're just doing it on the S&P. RYLD, they're just doing it on the Russell 2000. You are giving up, by owning QYLD, you're owning the NASDAQ 100, but you're giving up all the upside of the NASDAQ 100, all of it, because they're doing an at-the-money call option on the whole portfolio. You're giving up the upside of the whole portfolio for a massive monthly premium, which they don't even give it all out to you. So if you look at the distribution history, everyone, you could look. I really like this that they added this. Do you actually see? Hopefully you could see that. I made my face a lot smaller just in case. But basically every month they're doing a rinse and repeat strategy, like I said. And you could actually see exactly how much premium they're taking in. For example, April, Liberation Day, was a very volatile month in the stock market. You see that they actually made a 3.94% premium. That's only in 1 month. Of course, it's very, 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 very high because it's an at-the-money call premium on the whole portfolio. So they actually made 3.94% yield, if you could say, in 1 month. And you could see every month how much they're making, the orange part. But they only give out a maximum. They only give out 1%. They'll never give out more than 1%. So they made 394, but they will only distribute 1%, or less sometimes if the premium is less than 2%. So for example, February, there was not much volatility, I guess, in the stock market. Remember, call option premiums are based on volatility. In this case, the volatility of the NASDAQ 100. So if you have a very boring month with no volatility, the premium they're going to take in is less. So you see in this case, it's 1.78. They don't give out 1. They give out half of 1.78. So either they give out, if the premium is over 2%, is 2% or more, they'll give you 1% basically. If it's less than 2%, like in February, you're only going to get half of the premium, which is 0.90. So, you could go back and check, but maximum, basically, if the premium they take in is 2% or more, you're always going to get about 1% typically. Of course, if you look at the December one, it's much higher in this case, but that's because in December, ETFs have to give out all their capital gains. So that's why there's an exception. There's going to be an exception for December. But if you look at every other month, November, and if the premium was higher than 2%, they'll only distribute 1%. That's why the yield is always approximately 11, 12, 13% for QYLD. But this is not really, this is just an overview of what QYLD does. And by the way, they also have XYLD, like we talked about. They also have QYLG and XYLG. still from Global X on the US. This is not Global X Canada, by the way. It's Global X on the US. And basically, they do the exact same. QYLG does the exact same thing as QYLD, and XYLG does the exact same thing as XYLD, except they only write on 50% of the portfolio. They only do it on 50% of the portfolio, like it says here, instead of 100% of the portfolio. But they still don't give out the entire premium. So obviously, the premium of QYLG in April, 187, that should be approximately half of the premium that QYLD. So QYLD 3.94, and if you go to QYLG, it's 1.87. It's going to be approximately half because they're covering half the portfolio. But again, they still have that policy where they're not giving out the entire premium to you. They're holding back most of it. And if it's over 2%, I'm assuming they're going to give you 1%. But because they're doing it on half the portfolio, you see that it's much lower, right? So you're basically going to get half or 50% of what they're taking in, which leads to these lower annual yields, these distribution rates of about 6-7%, which is pretty much going to be about half of what QYLD does, right? And XYLG probably even a bit lower because the S&P 500 has less volatility, so they're taking in less premium. But so let's look at the evidence of why I think you should get out of these, especially the Ds, because the proof is in the puddings. The proof is in the pudding, not the puddings, but I guess the puddings in this case. And they've been around for a really long time. And now we have QYLD and XYLD are not the only NASDAQ 100 and S&P 500 covered call ETFs out there. There's been an explosion of S&P 500 and NASDAQ 100 covered call ETFs on the US stock market, which I feel are far, far superior, have far more superior strategies where they're not writing as much covered calls. They have a similar amount of yield, but much, much higher return. So let's check them out. And we're only going to compare them to the very basic ones. So you have GPIX. This is what I would call a basic classic S&P 500 covered call ETF. It's from Goldman Sachs. It has a very low management fee of 29 basis points MER. And by the way, QYLD, they recently reduced it, but it's still 60 basis points. So QYLD, XYLD, 60 basis points MER. Let's see the Gs. I don't even know what they are. 35. So a little bit less, 35. But guess what? The Goldman Sachs one, which is your basic S&P 500 covered call ETF, has 29 basis points. And this has a consistent yield of approximately 8%. You could see the monthly distributions if you scroll down, and it typically translates to approximately 8% yield. And this is where they're doing, in my opinion, a much better covered call strategy. They're not doing at-the-money calls covering the entire portfolio. You're going to capture a lot more upside of the S&P 500 with GPIX. Another one is SPY-I. Another one I would consider a classic S&P 500 covered call strategy. MER is 68. This one writes a little bit more covered calls on the S&P 500. That's why the yield is about 12% instead of 8%, but a very, very consistent monthly distributions. That's typically around 12% yield. And they have the exact same thing for the NASDAQ 100. So the GPIX and SPY-I would be comparable, obviously, to XYLD, right? Because it's S&P 500, but they have GPIC with a Q, QQQI from NEOS, the exact same thing as GPIX and SPY-I, but on the NASDAQ 100. So because the NASDAQ 100 is a little bit more volatile than the S&P 500, these ones have a little bit more yield. So typically GPIC, which again has the same fee, by the way, very nice low fee, monthly distributions as well, typically has a yield, an annual yield of 10% instead of GPIX, which is 8%. And QQQI has a yield of typically around 14-15% compared to SPY-I, which is 12%. But they do the exact same type of strategy, just on a different index. Let's look at the total returns. Total returns includes everything, everyone, absolutely everything. I've actually put QYLD versus QYLG versus GPIC versus QQQI versus QQQM, which is just the NASDAQ 100 index ETF from Invesco. And if you look at the 1-year returns, you'll see a really big discrepancy, especially with QYLD. And of course, a lot of these GPIC and QQQY has not been out for 3 years, but if you look at the 1 year, you could clearly see the trend. You see that GPIC and QQQI are greatly outperforming not only QYLD, but QYLG as well. Why is that? Well, of course, if the NASDAQ does well, which of course over time the NASDAQ 100 does well, the S&P 500 does well, again, over time, over the long term. And if you're giving up all the upside for those premiums, you're going to greatly underperform. If you look at the 10-year return average of QYLD, it's 8% a year versus, QQQM, they don't have it. Let me just go with QQQ instead. But if you look versus the S&P 500, for example, 13.65. All right, so I swapped out the QQQM for QQQ, which is basically like the SPY, but on the NASDAQ 100. And you see that we do have the 10-year data. Look how QYLD has greatly underperformed. 8% annual average return versus 18.72. So of course, if you're QQQ in the last 10 years, the NASDAQ 100 tech stock, very tech heavy, has done really well. If you're giving up all the upside, you're going to get destroyed in terms of total return. Now, of course, we don't have the data for GPIC and QQQI, but it's safe to say if we look at the 1 year, we could clearly see the trend, right? You see that QQQI, GPIC and QQQI are very close, and even QQQI is outperforming QQQ. So in terms of total return, but QYLD and even QYLG is not. So this proves two things. Once, it's a terrible idea to give up all the upside or write too much covered calls on something that does really well over time, especially in index. And even QYLG is underperforming, even though they're writing on half the portfolio. This proves that active strategies, in my opinion, this is my opinion here, but you're looking at the numbers, active strategies greatly, in terms of covered calls, outperform rinse and repeat strategies, which is what QYLD and QYLG does. So I would strongly think about it, guys, because if you're investing in QYLD, QYLG for the yield, well, QYLG only has like 6, but QYLD has 10, 11. I think you would be much better off total return wise with something else like GPICs and QQQI. QQQI especially has like 14, it even has higher yield than QYLD anyway. And look at the performance gap. I mean, it's absolutely massive. And the same kind of story with XYLD, XYLG, and versus GPIC, SPY, and just the S&P 500. You see that XYLD over 10 years, 6.93% average total return versus just the S&P 500, 13.65, less than half. Okay, not less than half, approximately half the performance. This is the problem with a rinse and repeat strategy where you're giving up so much upside. You're much better off with a GPIX or a SPY. You see that the performance, of course, it's very hard to beat just the S&P 500 when you're doing a covered call, but at least it's a lot closer. Whereas XYLD and XYLG greatly underperform. So I hope you enjoyed the video. Hope you learned something. Quick refresh on XYLD and QYLD and why they're underperforming. It's because they're giving up upside. They're too much upside. And when I mean too much, all the upside. So if you're American, by the way, you invest on the American stock market, you're an income-oriented investor, make sure to subscribe to my channel. This is what this channel is all about. And in case you didn't know, I actually have a monthly series which is on episode 63 right now. This is like 5 years I've done this. I can't believe this, where every month I go over the covered call ETF high yield landscape, and I literally have 2 episodes. One that focuses on the Canadian stock market. You can see the Canadian flag. One that focuses on the American stock market. And all those ETFs that I mentioned, SPY and GPIC and a bunch of other ones, because there's like a dozen S&P 500 covered call ETFs, a dozen NASDAQ 100. Those are the ones my channel focuses on to keep you updated on them every single month. If there's changes, we do total return comparisons. If there's any new funds, this is the channel, so make sure you subscribe. And by the way, again, if you're American, I do have a lot of Canadian content, but I have a specific playlist. You just click on the name of my channel, and go to playlists. I have a specific playlist called US market only content. So if you don't want to see anything related to the Canadian stock market, you could just follow that playlist. Give me a thumbs up. I would really appreciate it, everyone, and see you next time.